Today, we are talking about all of the changes being made to FHA loans.
Hi, Nina Gonzalez. You can find me on all the social media platforms. Loans by Nina, a VP of Mortgage Lending. We can lend all over the United States of America. But first of all, I just want to say thank you so much for having me on.
No problem. So a lot's happening, a lot of questions, a lot of changes about the loan programs that are out there. I did come up with kind of a list of questions of some things that I've been asked. So first, I just want to just kind of take it back to the basics for some people who aren't already familiar with the loan process or the loan products that are out there. So if someone is looking to get a mortgage, can you let them know what type of mortgage options they have?
Sure. First, I want to talk about maybe like what is needed, what is even needed. So let's just go there and start with the basics. We want to make sure that you have a source of earnings, right? So it doesn't necessarily mean employment. We want to make sure that you have the required documentation, which is basically we want to know where you live, where you work, how much money you make, and that's going to take a snapshot of your financial picture for the last 2 years. So
Okay.
you want to have earnings statements available. You want to have your pay stubs available, last 2 months bank statements, last 2 years tax returns and W-2s, and an identification. Like we want to make sure that that it's you, and we need a valid ID. So sometimes people have approached me with that, not even having a valid identification or have letting it expired. So that's the basics, right, of what documentations you need to get ready. But on top of that, we have the loan programs that are available. Traditionally is FHA, PA, conventional, and USDA financing.
Okay. All right. So which product would you say that most people go with?
Well, it's a mixture between FHA and conventional. That's the majority of clients do use those vehicles to acquire property.
Okay.
FHA is secured by the federal government. They issue an insurance to the lender in order for the restrictions not to be so stringent. So there are some flexibility in regards to credit score, debt to income, which is the percentage of your income that's going towards debt and the housing payment, and even more flexibility on the assets or funds needed for closing.
Okay.
And then conventional is also a very good loan product, and it has its insurances, but it's not insured by the federal government.
Okay. So I want to come back in a second and talk about a little deeper about the FHA program and a little bit on the conventional program. But first, can you share a little bit what the difference is between being pre-approved and being pre-qualified for a loan? A lot of times people get the two kind of mixed up and they think that, oh, I'm approved, but they're not actually approved yet.
Right. Excellent question. Thank you so much for bringing that up. That is something that can be very overwhelming to a consumer, okay? Because they stick to the pre, right? Because that's what it's the pre. That's what sticks with you. Pre-qualified, pre-approval. What does that mean? So let's start off with pre-qualification. A pre-qualification is basically you tell me how much you make. I may or may not pull a credit report. So there might be a single credit report pulled. How much you tell me how much you make, and based on that, I give you more or less how much you would get pre-approved for. I haven't really reviewed documentation. I haven't looked at pay stubs. I haven't looked at W-2s and things of that nature. I really haven't done a pre-qualification in many, many, many years, so I don't know what is involved, but some people do. I think you can do like a website, so you just click in what you think your credit score is, how much money you make, and basically it'll give you a pre-qual. Now those, it's just verbally. None of the information has really been verified or documented.
Okay.
Where in regards to a pre-approval, you have submitted and reviewed income documents and earning documents. I want to make sure that I talk about income and earnings distinctively, because I want to give those people out there who don't have a traditional employment but do have earnings, for example, pensioners, Social Security income, disability income, retirees, or even people receiving child support and alimony payments. Those are earnings and still can assist and qualify you for a mortgage. So we want to review earning and income documents. You want to look at tax returns, W-2s and 1099s. We want to also review bank statements, because we want to know that if a pre-approval is issued, where is the down payment coming from, right? So we want to have a clear picture of that.
Yeah.
So that is basically the difference. Your income is analyzed, your credit is reviewed, and your documentation is received and reviewed as well.
Yeah, I've seen some bad situations where the potential buyer have gotten pre-qualified for a much higher amount. So they go out, they think they have approval, we'll say for 200,000. And really when it boils down to it, sometimes it could be even $100,000 less than what they think that they can qualify for, because they didn't tell that loan officer about all of this other debt or responsibilities that they had. So it could turn into an ugly situation there.
Yeah.
So let me ask you this. There's a lot of people that are like unemployed, not working right now, kind of unsure about their employment situation. If they were prior to the coronavirus and they were planning to purchase a home, and how is this going to affect them, or what can they do to prepare themselves when we get through all of this?
I mean, that is a very big unknown to a lot of people. I'm sorry, I have to decline that call. That is a very big unknown. And what I want to give is some hope, though, right? So I want to give some hope. Mm-hmm. There is programs that will still allow you to finance even with employment gaps, as long as you have a legitimate reason. So this pandemic is a legitimate employment gap. If you were laid off or on furlough or required to take reduced pay, but then your situation goes back to exactly the same it was prior to, a good lender will make sure that all of that is properly documented, right? And still be able to get you approved. If your employment gap is under 6 months, FHA and conventional will still be able to get you financed. It's when the employment gaps are bigger than 6 months where you do have to provide a lot of legitimate paperwork, and you need to have the paperwork to back it up.
Okay.
Let's say that you don't go back to your same employment or employer, but if you go back to the same industry, same line of work, making the same or more money, that is still a legitimate income and source of income and can still be utilized to qualify you. So there is some hope out there. We're running into a small snag, and although it is unfortunate, I do feel that, we're in a great country and we will be able to bounce back. So a lot of individuals, as soon as they get back on their feet and with their same employer or a different employer making the same, in the same line of work, will still be able to get financed.
Okay. So during this time, some folks may have had to tap into that emergency fund, that savings account that they had. So, some people still try to save 20% for a down payment. Can you talk about that a little bit in terms of how much down payment money they need for either like conventional or going FHA?
Well, it's very subjective to their situation, but we want to say that the minimum required for a traditional purchase could be anywhere from 3.5% to 3%. Okay, so if we're going conventional and you qualify under the 3% down option, you can use the 3% down to get your, to acquire property. The same thing for FHA. The difference is on FHA, their down payment requirement is across all type of properties. Okay. So it's the same if you go single family, 2 units, or duplex, 3-unit properties, or fourplex, 4-unit properties, right? So it's the same 3.5 down payment. With conventional, it's dependent on the property type and credit score, your minimum down payment for each property. Okay. So a 20% down payment is not required. What will change and has been changing is the reserve requirements. So although you may have the 3.5 down payment or 3% down payment, depending on your credit score, there might be a reserve requirement. And a reserve is untouched money that's equivalent to 1 month of your mortgage payment that is not being consumed in down payment or closing costs.
Okay. Wow. Okay. So, so people really have to start putting some money away and start planning for this.
Yes.
Can you talk about the credit score requirement for both of these programs and what they're looking for? I know on FHA, it kind of shifted, went up, now it's going back down. And I think it sounds a little unstable on my end anyway.
Well, that's a very interesting question because I am a lender we recently added an FHA overlay to the FHA product.
Okay.
But FHA itself has not changed or made those changes. So it's the lenders that have, we've put in some overlays on this program in order to mitigate risk. Okay, because although a lot of people are going into forbearance and all of that stuff is happening for current homeowners, the lenders still have to pay out taxes, insurance, and mortgage insurance. So they have to tap into monies that they're not receiving in order to keep homeowners' taxes and insurances up to date, right? So that sort of retracts a little bit of the liquidity, a little bit of the money they have to continue lending. We have set some overlays in place, which was never before. It had never happened at our company, but I think they're still very moderate in comparison to what's happening nationwide, right? So we can still do the 620 credit score. We just have, our debt to income is it's just tighter, right? Okay. So the percentage of your income that could go towards that and the housing payment, it's going to be at about the 40 to 43%. And there are a month or two required for reserves. For 640, there is, the debt to income is more, it's wider, it's more, there's a higher variance allowed, but also there is that reserve requirement. And then once you get up to the 680, it's business as usual. So you're not tied into a reserve requirement and you're not tied into a debt to income restriction. So the higher the credit score, the least amount of restrictions on the financing.
Okay. So that's very important. So the lower the score, the more money, more savings you really do need in order to get the loan done. So that's a key factor that people need to really plan for.
Plan for it. So the good thing about reserve, though, keep in mind, you're not giving this money to anybody. This is not money that this is money that you're savings for your security in your future. right?
Okay.
So it's not, it needs to be documented, but it doesn't have transfer out of your ownership at all, right? So you document it, you have it, it's in your bank, we close, and you still have your savings. There is no, you're not required to bring that to closing. You don't have to have it in a separate account after closing for a certain amount of time. This is just keeping you, solid and putting you in a solid foundation after you close.
Okay. So with all of that being said, do you think it's still a good time to buy?
Yes, I do. I mean, I really do think it's a great time to buy for those of us who are, we're a key part of the economy that's keeping everything going. And there's a lot of individuals who are essential workers who have the income, have not lost a beat in in generating income. And now they have, they have just less competition in acquiring property. So the interest rates are still extremely low. We still have a lot of money to lend. I have a digital mortgage process that is, seamless from beginning to end. And the great thing is, this wasn't for COVID. Like, this is how our system had already been set up. And now it just is very COVID friendly. We have a digital mortgage process where you can upload all of your documents into a secure portal. You can verify employment, even through that portal, if your employer is set up through the automated employment verification systems. We can also verify assets through our account check system that will automatically have those assets into your profile and do an automated approval for you as well. So in the perfect storm, you can submit for an application and walk out with a pre-approval within half an hour.
I like that time frame.
I mean, it can happen. So it does have, there's a lot of keys to take advantage of all of that. Also, for our self-employed individuals, we have Loan Beam system that automatically analyzes your tax returns to the standards of the secondary market. So it automatically combs through all of your write-offs, your K-1s, your 1099s, your all the different schedules that you may have on your taxes, and analyzes them to the standards of the secondary market. So we don't have to go in and figure it out by hand. Your income is automatically calculated. So, and then when you get all the way to closing, we also have our e-close and flash close options, that the majority of the documentation is signed electronically the day of your closing. So when you're going to the closing with all the restrictions that are at the title companies, you're maybe signing 5 to 6 documents with at hand, but then all the rest have already been signed electronically.
Okay. So I will ask this real quick because I know you are self-employed. Just wanted to confirm with them or through you, how long or what self-employed and you want to purchase a home, the requirements, tax returns, and everything.
Excellent. I'm so glad you brought that up because I know we have a lot of self-employed people tuning in. I want to make sure that our potential self-employed applicants have the required documentation. So you want to have minimally 2 years of tax returns completed because your income is averaged out based on the adjusted gross income that you've reported to the IRS. Okay. If you've been self-employed for 5 years or more and it picks it up in the back-end reports, there's a possibility of you only having to show 1 year of tax returns, right? That's important for some people because those first couple of years, they could have been rough. And now you're really taking off, right? And you have this huge growth. With self-employed individuals, your income is averaged out over 2 years. That just showing 1 year of taxes after your growth, after your catapult, after that, that steady flow of growth, that can make a huge difference in qualifying. But the general rule, Okay, generally 2 years of self-employed income, and it's your income, your adjusted gross income is averaged out for those 2 years.
Okay. Okay. And then is, so some people may have been thinking about moving, but now they've decided to just stay put, stay where they're at. So for those individuals who have now decided to stay in their home, what do you suggest that they should do with their, should they go ahead and refinance? Is it a good time for them to refinance?
They can refinancing is still a strong option for anyone who qualifies or needs to take advantage of these lower interest rates. It's also a good time if you were looking to build a rental portfolio. It's also a good time to have a look and see if we can take out some equity, and that way Andrea can take you out and purchase some rental property, because that's what a lot of investors are doing. They're buckling up and they're getting ready to acquire property between the next 3 to 6 months, because they forecast that there will be some availability to acquire investment properties. So if you need to refinance to lower your monthly payments or lower your term, because I have some people who that's what they want to do. They see the rates so low. They say, wait a minute, I can get this low rate, have almost the same payment, but cut my mortgage in 15 years. This is the home I'm going to be in. I don't plan to sell this place. This is going to be a forever home. This is also a great time to confirm or visit the possibility of not only refinancing, but also possibly reducing the term of your loan. This is also a great time for those individuals who have experienced, some appreciation in their home values. If they feel that they have the right tools in play to take out some cash and be able to purchase another property, this would also be, we're still doing cash out refinances. We're still doing purchases. We're still closing and funding loans. So on our end, none of that has really shifted or changed. It's just available more so to the individuals that have not had any disruption in their incomes.
Okay. All right. Yeah. So I do want to confirm with you all that the real estate market, it's still very, people are still buying, people are still selling their homes. So that piece of it is really not stopping. It may have slowed down. We are considered an essential business. And so, a lot of our service can be done virtually, virtual showing. So if you still have an interest, especially if you're a buyer, it's time for you as a buyer as well, because there is a pool of buyers who aren't leaving their home. So if you found yourself, because before all of this, there was an inventory issue. We were low on inventory. You may find yourself writing multiple offers on properties. Well, just think there's a pool of buyers right now that are probably unemployed and not looking for opportunity to go out into the market and find that home that you've been looking for. So Nina, would you say, is there anything that you want to share with everyone that maybe we didn't cover, I didn't ask you, that you think would be beneficial?
First, I want to piggyback off what you said. I just want to say that's such an excellent point to bring up. That market is so active. Sellers are still selling, buyers are still buying. There is now just a smaller population of individuals out there searching for property. So it's a good time if you have, and you are not concerned with your income, and you have and are qualified or need to get qualified and pre-approved, it's still an excellent time.
Might need to double check. Might need to talk to like Nina, and reach approval is still good at this point.
Yeah, it is. Well, you want to revisit that anytime you're out there. You search any of my files, or anybody who's out there actually actively searching. We have been revisiting, looking at their pre-approvals, making sure that it's still in line, or making some adjustments if needed. Some people aren't even, they have their pre-approval max, but they're not even looking at that max anyway, right?
Right.
So need to know. What I feel everyone needs to know out there is the unknown, right? We don't know how COVID is going to impact us afterwards. And I'm talking to the individuals who might want to take advantage of any of the forbearance options on mortgage payments, on car note payments, on, not necessarily student loans, but there's all these other um, debts, all right, that are offering forbearance or, those kinds of programs and options. They've been directed, the credit bureaus really have been integral in ensuring that it's really not hurting your credit, right?
Mm-hmm.
It's really not hurting your credit. But at the same time, those balances are not going down. So that might have an impact on your credit. So the forbearance itself is, it's said not to have an impact. We're about to revisit that or see the first wave of those, right? Because it's only been a couple of weeks. So we haven't even been able to see or experience in the back end. How are lenders, how is the secondary market going to look at that and view that when getting you approved and ready for a new purchase? So that's something to be mindful of, that it's still an unknown. And we're doing a whole lot of research, and I'm actively looking to see how that will impact our applicants. But it's still, we don't know. Call your servicers. Make sure that you're calling your lenders. Don't just automatically assume that you're going to be able to skip your payment for a couple of months.
Right.
If you have the ability to do so, make your mortgage payment, right? Make your mortgage payment, make your payments, because at the end, when the forbearance period is over, your money's still owed. Like, that money is still due. So there's a possibility that it might be due immediately. It's a possibility that they might, spread it out for 12 months for you. But how will that impact your monthly mortgage payment at that point, right? Will that put you in a better or worse situation? So that's something to really consider, and read the fine print. Read the fine print, because it's hidden in the documentation somewhere. So I want to ensure, if there's individuals out there, families out there taking advantage of these programs that are available, be educated and ensure that these options that you're taking will not impact you negatively in the future, nor will it put you in a worse situation. All right. But that's not the one thing. I wanted to share that as just a little point of knowledge, that I don't think it's being, publicly addressed as much as I would like. But I wanted to talk about, being prepared with your renovation loans. Like, we have a very strong and active renovation team, and a renovation program that is highly available, that I think that's going to be one of the biggest programs that will be, really coming up to the market in the next, 6 to 18 months, where we give you the money not only to purchase, but also to do any work needed on the property. And that is, you can use an FHA loan or a conventional loan for those. So you can go in as low as 3.5% on a purchase, right? That includes the money to purchase it, but also to fix it up. That might be a distressed property, or that might just be a property that you saw. It's like, it sort of works, but it needs this. So that might be an excellent product that we should consider and explore further.
Okay. Sounds good. Well, there you have it. All of the information that you need to know. And can you say again, how can they reach out to you if they have any additional questions?
All right. You can find me, Loans by Nina, on every social media platform. That is Instagram, Facebook, and LinkedIn as well. There is a link to apply in any of those. You can just hit the website to apply to get pre-approved or refinance. You can also reach me at 312-532-8009. Once again, 532-8009.
Perfect. And then if you are not already, please make sure and follow the or like the Brick House Realty page. Who are interested in obtaining your Ohio real estate license. Tomorrow at 1 p.m. we are hosting a webinar. There is a link on the Brick House Realty Facebook page here. You can send me a DM. I can send you that link if you are having a hard time finding it. I talk to a lot of people who are interested in getting their license. We're just going through the how-to steps to go about doing that. Any questions, free to ask those to me as well. And have a good Friday. Thank you, Nina.
Hold on, I
joining
have
me.
to show off a little bit on you as well. Brick House Realty is recognized through, I mean, look, I'm all the way in Chicago and we have built a relationship for almost a year already, dedicated to their craft, masters at their craft, and really an integral part of their local market experts.
Yes.
There is, you have some construction background, and there's a little bit of that piece in their office, and they're just, a fully equipped real estate company that knows how to get things done and is constantly, if you're a seller, they're the ones to call because she's constantly posting on social media and everybody knows that she's working. So people scrolling, they will find your listing, not just through the listing services, but through their marketing and social media platforms and techniques. So, I mean, just kudos to you guys. You're doing excellent work.
I appreciate it. Thank you. All right. Well, I will see you. I will talk to you soon. And thank you, everyone, for joining us.